You know the feeling. You are staring at a fast-moving crypto chart, watching the price drop aggressively minute by minute. As the red candles stack up, the urge to guess the bottom and buy the reversal becomes almost overwhelming. But reacting to a single steep drop is a fast track to losing capital. Consistently profitable trading relies on a logic-based framework, moving away from luck or sudden emotional reactions to volatile price swings. Today, we are going to walk through a precise four-step checklist to identify, validate, and execute trades based on market indecision. We will look at specific candlestick shapes that signal when momentum is stalling. Implementing a mechanical, repeatable routine shifts the focus from reactive guessing to systematic trade execution based on clear chart evidence. Let's look at the shapes that make up this framework. This image illustrates what is known as a classic Doji candlestick pattern. The defining rule here is simple. The opening and closing prices of the asset must be exactly or almost exactly the same, creating a distinct cross shape. Next, we have a related formation called the spinning top. The key difference here is that a spinning top possesses a small but distinctly visible rectangular body right in the middle of the shape. To classify as a valid spinning top, the shape must meet specific mathematical constraints. The real body needs to take up less than 30% of the total vertical range, and the upper and lower wicks must be at least twice the length of that center body. These specific constraints tell a clear story about market psychology. The long wicks stretching above and below the body show that aggressive buying and selling pressure occurred during the session, but neither side could maintain control. Think of it as a tense tug-of-war. The bulls try to drag the price higher, the bears try to force it lower, and the session ultimately ends in a deadlocked standstill. Both sides are exhausted. When you understand the struggle behind these shapes, those random crosses become markers of market exhaustion, showing where the current trend is starting to lose its conviction. Step 1 is recognizing the shape. Step 2 is checking the environment. If you find a doji or a spinning top in the middle of a sideways, consolidating market, you are looking at noise. This chart shows how these patterns carry weight when they appear after a sustained, extended uptrend or downtrend. Here, the highlighted doji forms at the peak of a strong climb, signaling a shift in momentum. Notice how the pattern aligns with established zones. We look for these shapes to collide with a known support or resistance level to confirm that the current trend has truly reached a point of fatigue. Context is the ultimate filter. A mathematically perfect doji in the wrong location is often a trap, but a pattern forming directly at a major resistance zone presents a high probability opportunity. This brings us to a critical procedural filter. Never trade an indecision pattern in isolation. A doji indicates hesitation, not a guaranteed shift in direction. You have to wait for the very next candle to close. You are looking for a decisive move in the direction of your expected reversal. That follow-up candle serves as your market validation. This chart displays how to layer a secondary technical indicator, like Bollinger Bands, to further confirm the setup. Look closely at the highlighted pin bars. They are actively rejected, bouncing off the upper and lower band limits. The setup is validated when the subsequent price action breaks away from those bands following the indecision. The sellers take over here, showing that the deadlock has been broken. Step 4 is execution. You enter your trade immediately after that confirmation candle closes. Then you place a strict stop loss right below the lowest wick of your doji or spinning top to define your risk. Waiting for confirmation and capping your risk transforms a high-risk reaction into a calculated, mathematically protected trade decision. Let's review the checklist. 1. Verify the exact body and wick ratios. 2. Understand the tug-of-war psychology. 3. Check for a strong support or resistance context. And step 4. Wait for directional confirmation. Adhering to this framework provides a structured alternative to reactive trading, allowing you to prioritize data-driven analysis over impulsive responses to price action. The best way to build confidence in this system is to test it without financial risk. Open a free demo account on a platform like Light Finance, pull up some historical charts, and audit these patterns yourself. Mastering the market does not require predicting the future. It requires identifying high-probability moments of indecision and exploiting them with unwavering discipline.